Welcome to the deep dive. If you're tuning in, you're probably trying to get a handle on all this market volatility lately, figure out what's going on, and maybe what's coming next.
Yeah, it's been a bit of a roller coaster.
Totally. So today, we're really going to focus in on the S&P 500, specifically how it performed during the first 100 days of the current administration, Trump's second term.
And not just looking back, right? We also want to dig into the factors that might shape the next 100 days.
Exactly. Think of this as our mission, if you will. Cut through the noise, pull out the really key insights from what the market's been doing.
Figure out why it's been swinging so much and, pinpoint the major things to watch going forward. The idea is for you to feel informed, but not like buried in data.
Right, not overwhelmed. And our main guide for this is a pretty sharp article from The Motley Fool. It just came out May 4th, 2025.
Yeah.
And what really jumped out right away from their analysis was this assessment. They said the S&P 500's performance in these first 100 days, it was the worst for any administration in over 50 years.
Wow. Yeah, that definitely grabs your attention. That's quite a statistic to start with.
It is.
Okay, so let's unpack that initial period. The article talks about this initial roller coaster, right?
Yeah.
A really sharp downturn.
Yeah, triggered mostly by that big announcement about sweeping tariffs on goods from, well, most countries, basically. A huge move to try and reshape global trade.
And they pinpoint the date for that initial announcement?
Yep, April 2nd, 2025. That's when the news hit. And the market reaction was pretty severe.
Severe is right. The article notes both the S&P 500 and the NASDAQ actually fell into bear market territory after that.
That's a big deal, a bear market.
Huge. But then, almost as fast, things turned around. There's this rapid rebound in stocks.
Right. It wasn't a long, drawn-out slump. What caused the bounce back?
Well, according to the article, it was President Trump announcing a 90-day pause on those tariffs for most countries.
Ah, okay. So hitting pause to allow for
What? Negotiations. It's exactly. To create some space for trade deal talks. And the market, well, it seemed to really like that idea. It latched right onto it.
You could see that. The article even mentions, what, a 9-day winning streak? That was still going on as of May 2nd?
Yeah, a 9-day run. Shows you how much headlines about potential de-escalation can move things,
Definitely. But here's the kicker, and the article stresses this. Despite that nice rally back, the overall picture for those first 100 days, still pretty rough. The S&P 500, even with that winning streak, was still down about 8% overall.
Right. So that worst since 1974 statistics still holds even with the recovery. Down 8% is significant.
Very significant. So it's like a tale of two halves, really. Sharp drop, hopeful rebound, but still ending in the red.
Precisely. Okay, so that sets the stage. A volatile first 100 days. Now, what about the next 100? Where does the article suggest we focus?
Two main things, really. Trade, especially with China, is front and center.
Okay, trade. That makes sense given the tariff situation. That 90-day pause is still active.
It is, yeah. But when the article was written, about 24 days had already passed, so, the clock's ticking on that.
Right. Less than 70 days left at that point.
And the administration, they've kind of hinted at maybe talking with India or Japan, but the article says nothing's official yet.
And those feel like secondary issues compared to the main event anyway, which is China.
Absolutely. The article really digs into the China situation. The tensions there are already, well, pretty high.
How high are we talking? Does it give numbers?
It does. It mentions cumulative tariff increases by the U.S. on a lot of Chinese goods hitting 145%.
Oof, 145%.
And China's response. Retaliatory tariffs adding up to 125% on U.S. imports.
So huge barriers already in place. That's a lot of friction in the system.
Yeah. And it sounds like China hasn't been showing much sign of backing down either. The article says they've had a pretty firm stance against removing their tariffs.
Okay, so a bit of a stalemate, or is there any movement?
Well, this is interesting. The article mentions some recent reports suggesting Chinese officials might actually be evaluating potential trade talks.
Oh. Why the potential shift?
Apparently it came after, and the article quotes this, senior U.S. officials inquired through relevant parties multiple times. So some back-channel communication, it seems.
Okay. That could be something. But usually there's a catch, right?
There is. The spokesperson for China's Commerce Secretary basically said, look, the U.S. needs to remove all its unilateral tariffs first. That's the price of admission, essentially, to rebuild trust and start talking seriously.
So less an open door, more demand for a major concession up front. That's a critical detail.
Definitely. And the article really hammers home how important reaching some kind of trade agreement is, especially with China, if the stock market is going to find any real stability.
The uncertainty is just hanging over everything.
Exactly. And it's not just market jitters. We're hearing from companies too, right? The article mentions warnings about what happens if those high tariffs snap back into place.
Let me guess. Higher prices, maybe layoffs.
You got it. Higher prices for consumers, potential job losses. That's the fear for the wider economy.
And it's not just companies. The article notes a lot of market strategists are pointing to these tariffs and saying, this could actually tip us into recession.
An imminent recession, some are saying. That's a pretty stark warning.
It really is.
Yeah.
So the takeaway for the next 100 days seems to be expect more volatility, driven by trade headlines.
That's what the article suggests, yeah. Every piece of news, every rumor about negotiations could cause ripples. It's going to be a sensitive time if you're invested.
Okay, so trade is huge. What's the second major factor the article flags for the next 100 days?
Recession and stagflation watch.
Right, the R word and the S word. Even with the tariff pause, the chance of a recession this year has actually gone up.
Yeah, according to the article, it's because the economic data we're getting is kind of all over the place. Mixed signals.
Okay, like what?
Well, first quarter U.S. GDP, it actually shrank, contracted by 0.3%. That's usually a warning sign.
Definitely a flag. But wasn't there an argument that data might be a bit weird?
There was, yeah. The article mentions that maybe businesses rushed imports before potential tariffs hit, which could skew the numbers down temporarily.
Okay, so maybe an asterisk on that GDP number. What about positive signs?
Well, countering that, the April jobs report came in surprisingly strong. And the unemployment rate held steady at 4.2%, which is still historically pretty low.
So a weak GDP print, but a strong-ish labor market.
Yeah.
Conflicting signals indeed.
Exactly. And the article reminds us, the technical definition of a recession is 2 quarters in a row of GDP shrinking.
So that second quarter GDP number is going to be absolutely crucial. Everyone will be watching that.
For sure. And beyond the headline numbers, the article also points to some, let's say, emerging signs of weakness on the consumer side of things.
Okay. And then you layer the whole tariff uncertainty back on top of all this.
Right. It just adds another layer of complexity to the economic outlook, makes it harder to predict things.
And where does the Fed fit into all this? What's their stance?
The article describes them as being pretty cautious, kind of a wait-and-see approach for now.
Makes sense, given the conflicting data.
Yeah.
Are they worried about the tariffs themselves?
Yes, definitely. The article specifically mentions their concern that tariffs could push consumer prices higher. If imported goods cost more, that often gets passed along.
Which fuels inflation worries.
Exactly, and that's where the dreaded stagflation idea comes in.
All right, explain that one again. It's the nasty combo of
rising prices, so inflation, coupled with slowing or stagnant economic growth, and rising unemployment. It's kind of the worst of all worlds.
Yeah, sounds pretty awful. And particularly tricky for the Fed.
Right? Extremely tricky. The article points out that their usual playbook, like cutting interest rates to boost a weak economy, could actually make inflation worse in a stagflation scenario.
Because lower rates can stimulate demand, pushing prices up even more when growth is already stalled.
Precisely. It really limits their options and makes managing their dual mandate, keeping employment high and prices stable, incredibly difficult.
So, putting it all together, trade uncertainty, mixed economic signals, real recession risk, and this potential stagflation threat.
Yeah. The article basically concludes that continued market choppiness, volatility, seems like the most probable scenario for the near future.
Even with that recent winning streak we mentioned earlier.
Even with that, the article acknowledges the rally, but emphasizes that the U.S. economy still feels, pretty precarious right now. There's just so much uncertainty tied up in how these tariff policies play out.
Okay. So, given all that uncertainty, the trade tensions, recession worries, stagflation fears, what's the advice for investors? How do you navigate this?
The article is really clear on this. The key message is maintain a long-term perspective. Absolutely crucial.
Don't get caught up in the day-to-day swings.
Exactly. It specifically cautions against trying to time the market or chase short-term gains in this environment. The risk is just too high right now.
It's tempting, though, isn't it? When things are moving so fast.
Oh, absolutely. But the article points to history,
Yeah.
Historical data suggests that the longer you stay invested, the better your odds of positive returns become. It's about time in the market, not timing the market.
Ride out the waves, essentially.
Pretty much. The advice is basically try to stay calm, Trust your long-term strategy, and remember that patience usually pays off in the end.
Yeah.
Easier said than done sometimes, but sound advice.
Definitely. Okay, so let's quickly recap the main points from this deep dive. The S&P 500 had a rough start in the first 100 days, worst since '74, driven by those big tariff announcements.
Followed by a significant rebound when a 90-day pause was announced.
Right. And looking ahead to the next 100 days, it's really all about those trade negotiations, especially with China, and keeping a close eye on the economic data for signs of recession or that tougher stagflation scenario.
And throughout all this potential turbulence, the core advice is stick to your long-term investment plan. Don't let the short-term noise derail you.
Makes sense. Which, I guess, brings us to a final thought for you, the listener, to chew on. Given how? Well, unprecedented some of these policy moves and economic shifts feel right now. It makes you wonder, doesn't it? How might our traditional investment strategies need to adapt, maybe evolve in the years ahead?
That's a big question. Like, are the old rules still going to apply perfectly?
Exactly. Or might there be new things we need to watch, new indicators, different data points that become more critical for figuring out long-term financial health in this potentially new landscape?
Yeah, definitely something to think about. Food for thought, for sure.
It's a dynamic situation.
Absolutely. It really pays to stay curious and keep learning.
Thanks for joining us for this deep dive today. We definitely encourage you to keep exploring these topics and stay informed as things develop.